Everyone loves to brag about their real estate returns. I'm getting 12% cash on cash. Sure you are. The truth? Most investors get blindsided because they underestimate the hidden costs. And those costs will eat your returns alive if you don't plan for them. So today, I'm breaking down the 7 silent killers of real estate returns and how you can protect yourself. First up, tenants. When tenants move out, guess what? You're not just sweeping the floor. On average, turnover costs lender anywhere between $1,500 and $3,000 per unit. That's cleaning, repainting, replacing carpet, lost rent during vacancy. If your lease turns every year, say goodbye to half your projected profit. The fix? Screen tenants properly. Offer renewal perks. Aim for long-term occupancy. CapEx, short for capital expenditures. This is the big one that most rookies forget. That's roofs, HVAC, plumbing, electrical. Those aren't repairs, they're replacements. Industry rule of thumb is to budget 5 to 10% of gross rent annually for CapEx. Skip this and one roof will wipe up 3 years of profit. And insurance inflation. If you think that your insurance premium is fixed, welcome to 2025. Across the US, property insurance is up 20 to 30% year over year in many markets. And in coastal states like Florida, it's even worse. Your underwriting pro forma means nothing if you don't stress test insurance hikes. Property taxes. Here's the hidden sting. The second you buy, your county reassesses the value of the property at your new purchase price. So that cozy low tax bill that the broker showed you, outdated. Expect a bump, often at 10 to 20% higher after acquisition, and always underwrite at the post-sale tax value, not the old owner's bill. Property management fees. Managing your property always feels like you're saving until it eats your life. Professional management company runs about 8 to 10% of collected rent. It is so worth it. Cannot stress this enough. But if you didn't include it in your underwriting, well, your margins just disappeared. Vacancy loss. No building ever runs 100% occupied 100% of the time. Between turnover, slow leasing, economic dips, you need to budget vacancy. Industry standard is 5 to 10% vacancy loss annually. Skip it and your consistent cash flow dries up the second the tenant leaves. And small maintenance issues, that it's like small stuff that would add up fast, like leaky faucets, broken appliances, landscaping, pest control. It's a death by tiny cuts. Rule of thumb, budget 1 to 2% of property value annually for ongoing maintenance. And if you're not reserving for it, you're just crossing your fingers. So here's the truth. Real estate isn't killed by market crashes, it's killed by hidden costs that investors refuse to plan for. Turnover, CapEx, insurance, taxes, management, vacancy, maintenance. That's the dirty 7. Miss even one and your double-digit returns turn into pocket change. But plan for all of them, reserve for them, and underwrite with discipline. That's when real estate goes from whole play to a wealth engine. Because in this game, you don't win by being optimistic. You win by being prepared. This is Thrive Network. Comment, like, subscribe, and let's see you on the next one.